We've had not just two minor negative quarters. We've had minus 3% and minus 2.3% on gross domestic income. And you know what, Adam? That number rings true to me.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. I'm here today welcoming back macro analyst Mike Shedlock, better known as Mish, to the program. Mike was on the channel here a couple of months ago. A lot has happened since Mike was on. I think the theme of today's discussion is going to be, despite the real spike in optimism in markets today, the pressure of the underlying stresses within our system still continues to build to pretty concerning levels at this point. Before I jump into the discussion with Mike, I just want to point out, yes, I'm in a different background here. I ended up having to fly across the country for a family emergency. I may be ping-ponging back and forth between coasts for the next couple of weeks or so. So just asking your forgiveness and your flexibility in advance of some changes here on the backgrounds. Hey, Mike, great to see you. You've got a little bit of a different background too today.
Hey, we had some technical issues here. Adam and I both changed things around. So my background's not normal. Had some microphone issues, camera issues. Anyway, here we are. And yeah, Adam asked me about whether or not I had some news. I do. Gary Brode at Deep Knowledge Investment invited me to be on his board of analysts. And I'm happy to accept that. And if you look at the bios of these people, it is a fantastic group. And Adam, I think you need to get Gary on. I think you would be a great guest. And also, I'm migrating off of the Maven, off of, it's now called the Arena Group, I guess. I'm back to my own website where I will have more control over comments, more control over the layout. That's happening this week. Fortunately, the URLs do not change. But there might be some glitches as it takes GoDaddy to move from one server to another. So bear with me on that. I'm going to keep posting, but comments are disabled through at least Wednesday on my blog. And we're looking for a Wednesday rollover from GoDaddy, but it's still going to be mishtalk.com. So wish me the best on that technical maneuver here, Adam.
Yeah, technical transitions are always they're always rough. So good luck on that, but I'm sure it's going to go smoothly. And yes, everybody continue to go to Mish Talk. Now it's just going to be on an even better platform. All right, Mike, look, I got a whole long list of things here. And by the way, thanks for the recommendation for Gary. I wrote down, get Gary Brode on the show. So I'm going to make that happen. So number of questions based upon some of the recent articles that you published on mishtalk.com. Real quick before we get into them, let me just toss the softball I like to toss to you every time you come on this channel. What's your current assessment of the global economy and financial markets?
Heading into recession. It's been that way for a long time. And guess what, Adam? Hey, I was early again. I'm always early. and this last time I thought, well, I'm going to not try and be so early. You know, the U.S. had two consecutive quarters of negative GDP starting 2022. And I said, hey, we're not in recession yet. And we weren't. But when consumer spending took a dive in, I think it was April or May of 2022, I said, this is it. This feels like it to me. Consumer spending went down and it was down for a couple of months. And then guess what? Out of the blue, it shoots up again. Okay. All right. Well, it looks like it's going to be third quarter. The same thing happened again. Interestingly, 4 days ago, the EU announced recession. Mm-hmm. But they do it differently. They just look at two consecutive quarters of negative GDP. They call that a recession. That's not the way the NBER does things here. But we've got mixed signals here in the U.S. I didn't send you this chart, but gross domestic income and gross domestic product, two measures of the same thing. One of them signaling the economy is fine. Gross GDP is. Gross domestic income is signaling something else. we've had not just two minor negative quarters. We've had minus 3% and minus 2.3% on gross domestic income. And you know what, Adam, that number rings true to me, because when I look at all the part-time jobs that are out there, the full-time employment has been stagnant. Just a whole number of measures lead me to believe that that's the real number. The NBER takes the two and averages them. But even if you average the two, you still get two negative quarters of GDP. But by the time the NBER delays so long, the recession might even be over by the time they get around to making their assessment. And then we will know whether it's GDP is the right one or GDI or some sort of combination between the two of them. But regardless, the economy is weakening. And I'll go back to something that I wrote in August of 2022. And that is, the title of my post was something along the lines, whether you call it a recession or not, it's going to be a long period of weak economic growth. I think that's going to hit Europe even harder, and China. For all this China is restarting nonsense, guess what? China's struggling too. Germany is really struggling and will continue to struggle with deindustrialization of its automotive sector that it's been so reliant on.
All right. Great summary there, Mish. And just want to say, too, when you were talking about GDP versus GDI, I compliment to you, but David Rosenberg feels the same way. We had him on this channel 2 weeks ago. He talked about exactly that. And he said, and I imagine you would say the same thing, if when the NBR comes out and declares, if indeed a recession started this year, he wouldn't be surprised if we're already in it.
Yep, I've said exactly the same thing. Lacey Hunt has said made similar comments.
Yeah. So, all right. So two things. One, to your point about kind of like, it doesn't really matter whatever we call the recession or however we define it. What really matters, particularly for the folks that are watching this channel, is just what's the lived experience going to be, right? Because analysts and policy wonks can argue all day long about the technical definition of a recession, but when people start seeing their wages crimp, their hours cut back, maybe losing their jobs, et cetera, a lot of the type of fallout you get from a recession, that's what really matters. So from that perspective, what do you see coming ahead? How do you think this recession may compare to some of the ones that are still in living memory, like 08 or 01 or, earlier?
The direct opposite, and we've talked about this before. I expect the opposite of what happened in 2008. We had people walking away from homes. Now they're walking away from corporate real estate, hotels, and the like. So this is going to be a different kind of bust here. People weren't as leveraged in mortgages as they were in 2008. We didn't have the liar loans, the ninja loans, all that kind of stuff. But starting August, people are going to have to start paying back their student debt loans. I think that's going to take a crimp out of spending. Already we're seeing hours cut. I mean, you can look at the headline jobs numbers. Adam, they just do not ring true to me.
Yeah.
So I am, and if I'm online with what Rosenberg is saying, I'm happy, because he's a pretty damn good analyst, right? So I wasn't aware of that. So, that's good to know. But we have seen falling hours, and people say, oh, it's just tech, and, look at earnings, look at this, look at that. Well, guess what? In 2008, there was this meme out there. Well, China's going to decouple from the global economy. Now everyone believes the U.S. is going to decouple from the global economy. Now, Europe's clearly in recession now. So far, it's weak. But, what are they going to do about it? They don't have the policies and the procedures and the tools. And Germany's workforce is aging brutally fast here. So their infrastructure is terrible. Their internet connections, they got by off the auto sector, SAP, and a few other companies. Now there's not been a lot of innovation out of the EU, period. I mean, look at artificial intelligence. The EU is nowhere to be found. If anything, they're trying to suppress it, right? So what's the driver for growth in the EU? I don't see one. At least in the US, we can point to some things and say, okay, artificial intelligence, technology, the like. Biden's trying to catch up on with China on electric cars. The problem there is, where do we get the materials? That was what I wrote about today, Adam. So a very completely different kind of recession. But my synopsis to the COVID recession, which was it was very short, didn't even last a full quarter.
It was a blink and you miss it recession to a certain extent.
Yeah, it was 2 months of negative growth. But an enormous, unprecedented decline in employment and jobs, which I believe was undercounted, by the way. So now I think we're going to see the opposite of that. It's going to be much longer, much more prolonged, out of fear of stoking inflation. And look at Biden's policies. You can like them or not, but the policies are very, very inflationary. Where do we get the metals from? We have to build out infrastructure. Where do we get this stuff? Meanwhile, we're still supporting war in Ukraine. You can like that or not, but you can't deny that this is going on. I don't know. There's some pretty strong elements here of stagflation if you look at it.
Okay. Just to give you another kudos for thinking alike with another smart person, had Peter Bookvar on this channel last week. And he thinks similar to you, where he said he doesn't think you can't predict with 100% certainty there's going to be a recession, but he pegs it at about 99.99%.
Okay.
But he doesn't think it's going to be an event like we just, the economy just crashes. He doesn't necessarily think there's going to be a coincident stock market crash, but he just sees it as sort of this slow, prolonged grinding downwards, which I kind of get that same impression, but clarify if that's wrong. So when you say it's going to be very different, though, from some of these previous ones, from people's lived experience, so does that, obviously it doesn't seem like you think we're going to have the housing market collapse that we had last time around, because there's a ton of people in houses with very low mortgages. But how about jobs? Do you think we'll see continued layoffs building? Will the employment rate? Well, you and I even have a bet going on this, so maybe I'm asking a loaded question. But what do you think is going to happen with employment?
We do, Adam. We've got this marginal bet. What is it? Pizza and beer. I think maybe I don't know. Whatever it is, it is. But you thought the unemployment rate will be what, 5?
I think when we made the bet, which was in March, that I was more pessimistic than you and thought that the employment rate will cross 5% somewhere between March when we made the bet and next March.
Yeah. So it's still looking good for me, but these things can change on a dime. You can easily be right. And by the way, everyone, Adam hopes that I'm right.
I absolutely do. I do not want to win this bet.
We're not rooting for, our positions here. I don't want there to be a massive rise in unemployment, because I think it'll be painful. And the Fed, I don't think, and one of the reasons why I'm predicting this long, blown out thing, out of fear of stoking more inflation, I don't think, the Fed is going to resort back to, more QE, slashing interest rates to zero again. I think that's off the cards. I think we might have seen the secular low in interest rates, barring some severe economic crash. But one of the reasons why I think There's a difference between employment and unemployment. If you look at the last jobs report, and this has been going on for a year, unemployment has barely risen and jobs are up like what, 4 million or something in the last year. You look at full-time employment, it's only gained maybe 1 million. I think this ties back into the idea that Rosenberg and I had about, this matches GDI, folks, whether you like it or not, it does. So people, there's 3 classes of zombies here, and I wrote about this in a guest post on Deep Knowledge Investment, my first post over there. We've got corporate zombies that are barely alive, only because they can keep rolling over debt. Well, guess what? The cost of rolling over that debt is now monstrous. And we're seeing it in the commercial real estate side. We're seeing people walk away, or real estate investment funds walking away from hotels, walking away from, apartment buildings. They got these interest-only loans, and it doesn't make any sense to carry them now at 7%, but it made sense to carry them at 3%. So a completely different kind of recession. But I don't think we recovered all the jobs, in the fast food industries and the hotels and that stuff. So, okay, I think some of these openings are going to vanish, and ours are going to be caught more so before they lay off any people. But back to commercial real estate, and I know I'm ringing Danielle DiMartino Booth's flag here on that. But I think commercial real estate is going to be nasty. And if you look at, and I had a chart or some numbers on this. This is off the top of my head, so this might not be exactly correct. But the regional bank exposure to commercial real estate is like 28.6% of their loans and investments. The big banks, if the number I recall correctly, is like 6.8%. So when we have another decline in commercial real estate, it's these regional banks that are going to get hit. And we've already seen what's happened to 3 of these regional banks, right? So what's the Fed going to do? Come in. They're going to come in and they'll do something. They're going to bolster this up, but they're not going to be slashing interest rates like they did before out of fear of recession. And given Biden's policies and the push towards, clean energy and the push towards unionization of Biden, you can agree with it or disagree with it, but Biden's tactics, student loan forgiveness, all of that stuff, now that's going to go by the wayside, I believe, in the Supreme Court by mid-July. But we'll find out. And but he's got a big inflationary push, so which is like, it's unusual for me to be preaching a little bit of a stagflation message, but that's kind of what I see here right now.
Well, it's so interesting because I think a lot of people first got exposed to your work back leading up to 2008, where you were really kind of known as one of the bigger deflationists at the time, and now you are a stagflationist, it sounds like.
I waver, and I know both sides, and I did a post out there, and I said, well, okay, here's all the stuff on this side. Demographic is actually on both sides. We got people retiring. These are skilled workers. They're going to be replaced with non-skilled workers, so productivity rates to go down. So that's one side of it. You can say, okay, that's a little bit inflationary. You can also say, okay, boomers retiring, they're no longer working, they don't have that paycheck coming. And, guess what? They're going to, especially if the stock market is lower, they're going to try and reduce expenses. So, everywhere you look, the write-off of debt is inherently deflationary. So, I look at that and think, my God, look at this. This is another wave that's coming. We just have counterbalancing forces here now. We had globalization and offshoring. that allowed the Fed, central banks in general, to slash interest rates. We don't have that now. We've got reshoring. Germany is in a much worse boat than the United States is. So there's a lot of forces on both sides, and I look at both of them, and sometimes I say, well, I don't know. And then who's going to win the next election? Nobody knows that. And those policies. So do we continue them? Do we backtrack on them? What's going to happen? So there's a lot of stuff out there that just has me saying, you know what, the housing bubble, I was very confident of that it was going to crash. It was going to be a deflationary event. It was. And the resolution of that was the Fed stepped in, and John Hussman has talked about this too, and has ended mark-to-market accounting. Okay, let's let the banks, hold the stuff on their balance sheet, at whatever price they want. And off we went. And, the takeoff, the liftoff didn't surprise me because I called it in housing. I called the top and the bottom of the housing market. I just never thought that these bubbles would get as big as they did. And that's typically the position I'm in, Adam, and most people too. These bubbles just always have a way of going on much longer, and they go much further than almost anyone thinks.
Can think, yeah. And by the way, Lance Roberts has been reiterating that a lot recently with the current potential new bubble that we're seeing in the AI stock markets right now, where you got companies like NVIDIA that are priced at 40 times sales. And he's like, as bananas as that is, that's not a train you necessarily want to step in front of and start shorting.
No, exactly. You don't know when it's going to end. And people were talking, so, well, look at this, a crash is coming. Well, I'm sorry, crashes don't come from overbought conditions. Crashes happen in oversold conditions. And, we need to see a significant decline, and a decline that fails before we can even start talking about crashes. We're not even close. It's pretty amazing here, Adam, how things lifted off.
All right. Well, look, I want to get to some of your more recent pieces, but just to stay on this for a second, you said there's kind of a lot of cross currents going on, which make this the future trajectory from here harder to call than, say, back in 2008 for you. Do you see it more as sort of like a patchwork quilt, where in some parts of the economy we're going to see inflation, some parts we're going to see deflation because of these different cross currents? Or is it more, you think, like Felix Zulauf described the road ahead for the next decade? As you said, it's going to be the decade of the roller coaster, where we're just going to have these great big swings from one side to the other as things start to deflate, and then policy responses push things back up, and inflation resurges. And so he just says we're going to kind of be lurched around back and forth by these sort of tidal forces over the next decade. Do you lean more towards?
I like the second one. I don't think we've seen the bottom in the stock market. I really don't. And it's funny. The Wall Street Journal came out the other day. I don't know if you saw the post. A new bull market has started. Well, lovely. Okay, really? It's possible that it has. Okay, you have to be open to the possibility that we're in a new bull market. But a bull market's not confirmed until we take out the previous high. Now, I went back, and recently I posted a chart in one of my blogs. We had two 50% rallies and one 40% rally, while the NASDAQ fell from 4,000 all the way down to 700. So, I'm sorry, none of those 50% rallies started. A 50% rally is a huge rally, right? Here we're only talking about a 20% rally and a call of a new bull market. Well, it's possible. I just kind of doubt it, but certainly it's not confirmed. And if the Wall Street Journal would bother to look at that NASDAQ chart from 2000, they might want to change their mind as what a definition of a bull market is here. So yeah, I think we're liable to see some swings. We're in one right now, a 20% rally in the S&P. So if we go on to make a new high, well, I stand corrected. Sorry. But as for long sustainable growth in the stock market, given my analysis of a long, prolonged in and out recession for potentially years, it just doesn't, and I'm going to stick with that forecast. So, especially what's happening globally. So it just doesn't jive that the stock market's going to take off here and not look back.
Okay. All right. Well, look, and I do want to get to maybe a little bit more of your specific market outlook and what assets you think might be wise given that, but let's save that for a little bit. So you mentioned that here in the States and other countries as well, but a big part of what we're doing here in the States is to try to bring some of our supply chains back, definitely electrify the transportation grid, right? Lots of spending already earmarked for that in the Inflation Reduction Act. That is part of the liquidity that's going into the system now, but that will be a big wave of spending over the coming years, especially if the Biden administration stays in office next year. And so that's inflationary in and of itself. But what's interesting is there may be some limits on our ability to do that aren't policy related. No matter what policy is, just finding and getting some of these materials is becoming more and more challenging. And you addressed this in a recent piece. So if you can just sort of elaborate for folks, these are some of the pressures and stresses I was talking about earlier. What is going on with materials right now, some of these critical materials?
I can't even pronounce the names of some of these things. I had a cheat sheet up, we had to switch the layout here, so I don't have that in front of me. So I'm not even going to mention some of the names. But I sent you a couple of charts, and if you have time, you can work them in. But the U.S. did an analysis. It just came out, I think, a week or two ago on what is our risk here of what minerals do we need, and you go up and down the line. The U.S. China is overwhelmingly the huge source, but it's not always China. Indonesia on one, and South Africa, on another one. Zimbabwe has a huge piece of one of these minerals. But there's a lot of geopolitical risk here, especially with Russia is a producer of some of these, with Russia and China producing these minerals, and President Biden, and before him, Donald Trump, antagonizing, not Russia so much, but China with trade wars. And we're, continuing these trade wars. Taiwan is very much in the picture. Does China shut off the supply of some of these rare earth minerals? Now, I took one of the charts that, from that energy assessment, and I put my own spin on it and said, okay, there's two things. How critical is this, to the U.S. or, to energy, global energy? And then what are the supply risks? And I multiplied those two things together and came up with a number. I don't know if this is a valid approach or not, but, the critical list that I came up with might be a little bit different than, but pretty much they were in line with what the Department of Energy, came up with. But you look at some of these things, and there's a risk of running out of supply by 2025. If we don't step up production. Well, the U.S. we're not going to open a mine here, Adam, in the next 2 years. I think it takes 8 or 10 years to open a mine, and then plus the permit. Imagine the greens going nutsoid if we start opening, because a lot of the toxic sludge that comes from producing these minerals, you got to get rid of it. China is one of the few places on this globe that's willing to process these things and get rid of all of that. So then, what does that say to our supply, especially if we start really ramping up like Biden wants to do, what we're going to do? So I don't see, and I never did, where these minerals are coming from. And now, it's not just me saying this. We've got actually official government documents saying, hey, what? Look at this. There's at least a handful of things here that are, in critical supply, and China controls all of them. So, what do you do?
Just to, again, underscore your point there, we've had both Rick Rule and Tommy Costa on this channel, who are both natural resource investors. And, they've been banging the drum for years that even just at current growth rates, current demand, we're going to be hitting some pretty serious supply shortages going forward over the next decade or two, because we have underinvested so much in CapEx in the mining spaces for so many of these metals. Also, same is relatively true for just main energy, main fossil energy sources too, oil, et cetera. So, but they've really been warning about this, and now we're beginning to see those chickens come home to roost. And like you're saying, Mike, we're actually finally seeing the government, publicly begin to admit how critical the supply forecast for some of these things are. So, anyways, yeah, to me that just seems like we talked about some of the inflationary things from the existing plans to invest in infrastructure, but that may be sending some of the cost of these materials skyrocketing, because
it's even worse. It's even worse, Adam, in Germany. They don't have big deserts in Germany. Where are they going to put the solar panels? They've actually started mining. Their percentage of coal is like up to, I'm going to guess a number here, something like 33%, almost a third of the. They kicked out nuclear, and Germany is one of the, if you look at the fault structures and anything, one of the safest places in the world to build nuclear. Well, they killed that. And, to supplement their energy needs, what are they going to do? Solar's not going to work there.
Yeah, well, sorry to interrupt, but right now what they've been doing is burning more coal than they burned.
Yeah, exactly. That's why, they in the last 3 years, their reliance on coal went from, throw out some numbers here that are approximate, went from 28% back up to 33%. So what are they going to do? And Germany's a big export nation, but they've got a huge, trade deficit with Germany and their car situation. One of the few things that they did export to China was their cars. But China is now taking the world lead in car exports. Not going to be buying German cars anymore, Adam.
Wow. All right. Crazy. All right. So sort of continuing this stagflation theme here, cost of living continues to rise pretty dramatically. You've written 2 pieces recently I want to touch on. One is the fact that it seems that the consumer, they're still hanging in there spending wise, although retail spending, hasn't been super robust. But it seems what they're doing to be able to enable continuing that spending is they're shifting how they're financing it, right? So they got, stimulus during COVID. They had forbearance programs. There was child credits. There were all sorts of sort of special, extraordinary measures that were being taken to support folks during the pandemic. Most of those are gone now. There's a few important ones that are still around that are going to end soon, like the student debt. It's going to go back into repayment, as you've been mentioning. And so what we're seeing is that as people are draining those excess savings that they had, they're now turning to revolving credit. And I think credit cards are now back at all-time high in terms of just outstanding credit card debt. But they're now also, I believe, charging all-time high interest rates too.
Yes. The chart is misleading and accurate, both. We're at an all-time high in nominal terms in credit card debt, but that's not adjusted for either population or inflation. And so, I posted a chart on my blog on this. So we're still inflation adjusted. We're below pre-pandemic level. We're even below, I think, or right at the level, all the way back in like 2007, I think. But the trajectory is unbelievable. The steepening, the rate of increase in expansion of consumer credit and especially credit card debt. What's that say? I think it says that, hey, whatever savings anyone had, as a result of all the forbearance programs you mentioned, of all the free pandemic aid we had, has run off. That the money's been spent. Some people say it's still out there, but a lot of this was fraud and got into the hands of people who really didn't even need aid. And guess what? They're not going to spend that. They've already invested in the stock market or whatever. It's not going to be consumer spending if that money is indeed ever going to come back into the economy at all. So that is wearing off right at the same time that people are going to have to start paying back their student loans, and the rent forbearance is now gone. So it's a telling chart. Perhaps it's not as bad as it looks, because if we compare it to previous recessions where inflation adjusted, we're still not at an all-time high, but the steepness of how fast this is rising is very scary. I think that's probably the more important takeaway out of this. So, that's kind of telling something's got to give. Either people need to start making more money, and I think wage growth is starting to level off or come down. And certainly you look at people job hopping, for a long time, people were, just willing to go get another job. And we're almost back to normal levels here.
Right. Or to quit.
Yes, that's what I'm talking about.
We had the great resignation.
So, an outright quit, they were, taking another job, getting a higher rate. Well, people have stopped quitting, or actually not stopped, we are down almost to what we were pre-pandemic. It's still elevated because it was elevated then. But, maybe this is sort of a new normal. I hate that phrase, with, all the, boomer retirements we have. So it's one thing that's like still supporting wage growth, but nowhere near like it was. All these things, all these are just tiny little pieces of the puzzle that just, fit together, that paint a picture that say, what, these GDP numbers just really don't look right.
Yeah. Well, I hate to ask the question this way, but if you look at this, and you see, cost of living going up, right? You see, wage inflation, which has increased. It's still negative on a real basis, and we're beginning to see weakening in the labor market. I had a chart in a previous video last week showing that the labor leverage ratio has been declining for a while, and that's because we had the Great Resignation. And it's funny, we had this pandemic, which we shut down the global economy, but we put so much juice in there that a lot of people were like, "Hey, the job I have sucks. I'm going to go sit on the beach for a while. I've got some money, or my portfolio did really well because of all the stimulus, and I'm going to retire a few years earlier than I thought I was going to." Right now that excess is coming out, people are having to, now have kind of near record low savings rates. People are turning to the credit card to make ends meet. They're no longer able to kind of demand as many perks, or they can't be as aggressive with employers as they were in the past. I said several years ago, and I'll just say it here to keep it on the record, that I believe that the Great Resignation was going to eventually devolve into the great "please may I have my job back" movement, and that may be the case here. But just so there's all these forces that just show it's getting harder for the average consumer, right? Things are getting more expensive. They're now losing leverage in the workforce. They're falling behind on a real basis. Their personal debts are going up. It's not a great trajectory. And I kind of think, especially on the cost of living side of things, yeah, it wouldn't surprise me if CPI gets back down to, the Fed's 2% or less target level at some point, because some of the other deflationary forces that are going on and the challenges to growth, like you're talking about with GDP. But I make an analogy with like what happens all the time in commerce, like with the airlines, right? Where oil prices go up. So airlines, they remove things they used to give you. We all remember you used to get the blankets and the pillows for free, and that was all fine. But then they put on these excess costs because they say, hey, oil prices are so high, we need to have this short-term temporary, fee increase because we need to be able to still, afford to fly you, right? Then oil prices come down, those fees never go away, those removed perks never come back, right? And so it's always sort of this devolving customer experience. And I believe people are out there saying, gosh, inflation's been horrible, I just can't wait for the day when prices come back down to make sense. I think in a lot of cases, prices aren't ever going to come back down to pre-pandemic levels. And a lot of this inflation, even if the growth slows or even goes to zero, we're not going to roll the date back. And food's not going to cost what it was. Cars aren't going to cost what they were. Housing's not going to cost what it was. So I see this concerning, continued squeeze for the consumer going ahead. I'd hate to paint such a dire picture, but do you feel the same, or do you look at it differently?
No, I think you've hit it there pretty hard. Food is possible, but
food is possible.
But rent, I'm really doubting it. And rent is 33% of the CPI.
The CPI calculation, yeah.
Yeah. So in one way or another, shelter is 33% as we got owner's equivalent rent. But I mentioned the word zombie, but I never finished that point earlier. The normal meaning of zombie is someone who is a corporation that needs low interest rates to keep rolling over the debt because they don't have enough profits or any profits to survive other than by continually rolling over debt. The zombie corporation is going to go under. But I came up with two more classifications of zombies, and it's I define them as someone who is renting now and wants a house, but has just finally realized, hey, I'm never going to be able to afford this house. And then we got another class of zombie, someone who even owns a house, but is got a 3% mortgage rate. And that person can't, wants to move, could maybe even afford to move, except they don't want to give up their 3% or below 3% mortgage for a 7% mortgage. We have a lot of people trapped. And meanwhile, corporations are starting to demand more people come back into the office. So I think this impacts the quit ratio here. This combination of factors. So people can no longer work at home. Okay, if they've got a house close to where they can't afford to move. All of these things, if you look at it, it's housing tends to drive the economy into recession and out of recession. If by some miracle it didn't this time, then it's just we're not going to have this recovery as long as mortgage rates are at 7%.
Right.
I even doubt 6%. So it's slowing down household formation. I didn't write about this, but I've seen other people write about it. The U.S. birth rate is what, the lowest ever? Did I see that report recently? So, that says something to household formation, the ability and desire of people to have kids because they can't afford them. They can't afford a house. They're worried about school. Especially if they live in a large city. I mean, the education system in, just to pick two, Chicago and San Francisco is horrendous. But, so they're stuck. And I think people are going to be stuck for a long time. They're not going to walk away like before. They might even have a little bit of paper equity in their house that it's hard to cash out, but they just can't afford to move because they can't afford to hire the mortgage rate. And if my analysis is correct, out of fear of stoking inflation, the Fed's not going to be able to put the pedal on the gas on QE and mortgages. This is a huge problem of the Fed's making. You know, they've never admitted this. They're not going to, but the Fed really, really blew it and put us into this zombie-like economy. And yeah, we might have a roller coaster as they try and extradite themselves from this mess. I'm just failing to see how they extradite themselves from this mess, Adam.
All right. Yeah. Well, that's what occupies a lot of our time and attention here on this channel, is trying to figure out what's going to happen, because in many ways we are kind of, the Fed really has kind of backed itself into a corner. So real quick, just to finish out the housing topic here, you had written an article recently about the proclamation that there basically are no more starter homes left in America because the pricing is just too high for new home buyers, first-time home buyers to get into the market. Totally understand that. I'd love to have you make any commentary around that you want. My question is because I've asked this a couple of times recently to some of our experts. The transactions have really slowed down, right? Yes. Because it's hard to buy and people don't want to sell, like you just said. They're sitting on those low mortgages. Housing in general is stickier than financial assets, right? The price of the housing market moves more slowly than the price of stocks, just because it's a much less fluid, liquid asset, right? But transactions still happen, right? Even in a slow market like now, there's an organic amount of transactions as people die, get divorced, have to move for jobs, lose their jobs, et cetera, right? And over time, those should, you would think, that would be the price discovery mechanism. And given that mortgage rates are a lot higher now, and some other factors we could easily talk about, we would expect prices to be coming down. Will those organic transactions, even if they're a relatively small percentage of the market, will they eventually bring the stock market down if interest rates stay this high? Or are there other factors at play that might keep things elevated?
I'm not sure that housing is tied that much to the stock market, other than perhaps in the reverse sense. If the stock market does take a dive, negative
wealth effect.
I can afford to do this, that, and the other, to spend, buy more in a house, upgrade my house, buy new furniture, whatever. So in that sense, I think they're related. But and I do expect home prices to decline. But what's interesting is, I think the last at least 2 months, or is it 3, Case-Shiller said home prices have risen month to month. And that wasn't every market. So, and that's really not a good market for the Fed, by the way, because if things stabilize here, we're stabilizing at a point of unaffordability. It was like Point to Homes did this article. They surveyed what the average renter was making and what a lower tier, third tier starter home they defined as bottom third of price in the area. Okay. So Point to Homes did this analysis of who can afford a starter home. And they looked at 100 markets, and in precisely 0 could the average person renting now actually afford to go out and buy a home priced in the lower third. So, that's pretty telling. And that's, again, telling on household formation. And just think of all the things that goes into buying a house. A home builder builds a new house, a new appliance, carpeting, paint. You buy an existing house, you refurnish, you put in new cabinets, almost certainly new carpet, landscaping. you upgrade the lawn, curtains, all that kind of stuff. That's activity that's just not going to happen.
Right. So there's an economic multiplier effect of home construction. You take that construction away, you get this multiplier effect going in reverse, right?
Yeah, actually, if you total it up, housing is not that huge of a portion of GDP. However, it's a cyclical portion. Government spending doesn't change much except go up every year, right? And government spending adds to GDP. Now we can debate whether or not it should, and this is another reason why. This may be actually an important point here, where GDP's inflated. We build bombs, we drop them wherever, doesn't matter. We always seem to be dropping bombs somewhere. Okay, so this added to GDP. So we got product. We used the product. It's totally gone. It's wasted. We got nothing out of it. We made enemies in the process, and yet they're telling me that this added to GDP. So I think a better term for GDP is grossly distorted procedures rather than gross domestic product. And I don't know if Rosenberg's ever done this kind of analysis or not, but maybe this is what GDI is saying versus what GDP is saying. But anyway, nowhere do we account for the amount of money we spend that we've just totally wasted. It just adds to gross domestic product. So there's something wrong there.
All right. Well, I got two questions to ask you in our last couple of minutes here as we wrap things up. The first one, why don't we make the first one your market outlook, which is just sort of what do you expect ahead for the second half of the year, and are there any assets or strategies that you think would serve the average investor to consider right now, given where you think the markets are headed?
I'm still, if you want to be invested in stocks, I still like foreign stocks over U.S. stocks. I think the U.S. market is grossly inflated. One of the things that happened recently, and I wrote about it on my blog, was we filled gaps. And, the gap is where the stock opens above the high of the previous day and stays there, or below the low of the previous day and stays there. We had like 14 gaps that have all been filled now. The only two gaps that remain are below, where the stock, and it's kind of interesting here with this NVIDIA rally, the S&P gapped down 8 months ago, and it's now taken 8 months to fill that gap. And I was wondering, is this gap going to fill? But I swear to God, Adam, gaps just act like magnets. And sure enough, we went back there. So anyone who shorted that breakdown and didn't take their profit somewhere along the line, they had huge chances to do so, is now back to even. And we see this on gap ups too. Now we have two stacked open gaps, one at like 39 and one recently, I'll say 41, on the S&P. So I think I'm positive these gaps are going to fill. So and I would guess sooner rather than later, then we can talk about what happens then. But I don't think the low is in, not by a long shot. And if for some reason it is, then it's this muddle through kind of thing. That's not going to do pension funds any good if, they're expecting 6% returns and all we're getting is this, this sideways range movement. I still think lower lows are coming.
Okay. Lower lows are coming. And I'm going to assume, sort of like Bookvar thinks the economy is going to be sort of in a slow grind downward from here. Are you expecting that the markets will hit those new lows kind of in a slow grind as well? Or do you think it's going to be a bit more?
No, that's going to be more depending on euphoria over nonsensical announcements from the Fed and stuff like that. NVIDIA coming out, with earnings, exuberance over artificial, intelligence, AI, the like. But, one observation is bull markets don't end on bad news. Bull markets end on good news. And we've
Yeah.
had a heck of a lot of good news lately.
Yeah.
We've had
It's just so funny because, a couple months ago, it was not the case, but all of a sudden it's everywhere.
Right, exactly. So that was always skeptical, and it's all this bad news. But we had bad news, and that stock market didn't drift lower. And I'm sitting there, okay, look at this gap up here. This sucker's going to fill. Now I feel it in reverse. The gaps are below, and they're gap ups. Anyone who bought that exuberance and hold on is probably going to regret it. I would suggest that about Nvidia, Apple, any of these companies. I think the stock market is grossly overvalued. But guess what? I mean, if you fight this stuff, you lose money. It's kind of hard for money managers who don't participate in bubbles, lose clients. That's just what happens.
Yeah, you're forced as a money manager to follow the John Hussman paradigm, where he says, manias force you to make a decision to whether to look like an idiot now or look like an idiot later, right? All right, the last main question for you, which is, we've talked about a lot of pretty pessimistic stuff in terms of the direction of the economy and the future for the consumer. Just as an exercise, I want you to try to put on a bull hat for a moment and just say, if the future is different from what we've been talking about here, and it's much better than what we're talking about here, do you have any sort of sense of what could be those catalysts? If I had to say, Mish, make the best bull case you can make right now, what would you be doing?
That's pretty easy. The U.S. is certainly leading in artificial intelligence. Europe is lagging. The U.S. is ahead of, especially with Tesla, ahead of Europe on electric cars. Like Elon Musk or not, I mean, the man's a genius, actually. And the U.S. economy is still one of the most freest open economies in the world. So compare and contrast that with the nannycrats in the EU, and you have a different kind of thing.
All right. And sorry to interrupt, but is that sort of the Brent Johnson argument that capital flows will continue to come into U.S. because even though it has its problems on a relative basis, it's way better than a lot of other places, right?
Yeah. And look at China. The demographics in China are sinking, pretty fast here. So everyone thought that, not me, I was not in that camp, but most people thought, China was going to rule the world. And maybe they do still, but it always seems to be right around the corner. And now doesn't seem to be the time. They've still got massive property bubbles in China that they've not extradited themselves from. And they're still relying, on exports. Maybe they can do that with EVs, but if Biden and Europe put high enough tariffs on them, they won't. So those are the factors. That's the bull case, and it's considerable, actually. The U.S. is still the best of the lot. I think pretty much that sums it up. But and is leading, in artificial intelligence. China probably number 2, and Europe is trying to suppress it. So if you want a basket case, look at compare the U.S. to Germany.
All right. Thanks, Mike. And just for viewers, I am still working on getting an AI specialist on the program here to really dive in deep into that topic. All right, Mike, look, we talked a little bit about your site at the beginning of the interview here, but again, for folks that have really enjoyed this discussion, want to follow you and your work, where should they go? It's
still, and this is the good part about the move. And just to recap, if you're joining this video at the end or missed the beginning, or I'm moving mishtalk.com back to WordPress from the Maven, but the URLs are staying the same. So hopefully no links get broken, anything like that. That's happening this week. Comments are shut off on my blog. and I'm going to be doing more guest posts, and I offer you to Adam to provide some for me. If you've got anything from your fantastic, collection of interviews that you want me to post, I'm open to that. Gary Brode at Deep Knowledge Investing invited me onto his board of analysts. I'm there. He's going to be doing some actual investment ideas. So, one of the criticisms on blog over the years is I just talked about the macro picture. I never said, do this, don't do that. People want investable ideas. So Gary's going to provide some of those for me. I'm going to cross-post some of my macroeconomic stuff on his site. And Adam, you're welcome to join this party if you would like.
Thanks, Mike. And that's a great compliment, actually, between your content there and Gary's. I appreciate the offer, and I will hopefully be able to take you up on it. Mish, you and I have known each other for a long time, back in the days where I used to write a lot. And I just don't have much time to write anymore with all the interviews that we're doing here. But I would love to get the opportunity occasionally when I can to pull back out the keyboard and do some of that. It'd be really fun to post it on your site. And again, maybe when we have a particularly good interview here, I can do a write-up around that, send it to you, and can share that with you.
Exactly that kind of thing. Awesome. I'm looking forward. I always Lynn Alden and I don't see things exactly the same on crypto, but we see some things like there. I mean, I don't know what's going to happen, but I think Lynn Alden is brilliant, and I look forward to seeing more of her work. And of course, I follow Danielle DiMartino Booth real close on Twitter. So you've had a lot of amazing guests, and people need to subscribe to your channel to see them.
You're too kind. All right. Well, look, and wrapping up here, two things, folks. One, Mike just did a phenomenal job of walking through all the challenges that the economy and the markets have lying ahead of them. If you are feeling a bit overwhelmed about how to position for all of that, you're not alone. In fact, most people are in your camp. As always, we recommend that you work under the guidance of a professional financial advisor, but particularly one that understands and takes into account all the issues that Mike and I talked about here. If you have a good one who's doing that for you and building a personalized portfolio for you around that and then executing it for you, great. Definitely stick with somebody like that because they're rare. If you don't have one, or if you'd like a second opinion from one who does, then consider scheduling a free consultation with the financial advisors that Wealthion endorses. To do that, only takes a couple of seconds. Just go to wealthion.com, fill out the short form there. Again, those consultations don't cost you anything. There's no commitment to work with these guys. It's just a public service they offer to help as many people as possible. And if you've enjoyed having Mike on this program, would like to have him come on here again in the near future, please do me a favor, support this channel by hitting the like button, then clicking on the red subscribe button below, as Mike encouraged you to, as well as that little bell icon right next to it. Mike, it's always great having you on the channel, buddy. Thanks so much for coming on. Look forward to having you on again soon.
Adam, it's a pleasure. And we go back to what, 2006 or something? We've been working
6 or 7. I mean, it's been that long.
It's been that long. And there's going to be more coming up. Exciting announcements from Adam and I. You can count on it.
All right, buddy. Thanks so much. Everyone else, thanks so much for watching.